In this week's video, we'll be hosting a single elimination ETF tournament to help us answer the question, are the end of QE and tariffs the 1-2 punch that will knock out the bull? The fact that the European Central Bank announced the end of its quantitative easing program this week came as no surprise to the markets. As these dated articles show, the markets have been well aware for a long period of time that QE in Europe was nearing an end. September 1st, 2017, ECB to announce QE cutback in October, shut program by end of 2018. September 8th, 2017, European Central Bank signals end of cheap money era is coming. The other articles are dated October 26, 2017, December 9th, 2017, September 7th, 2017, January 19th, 2018, and January 30th, 2018. A few weeks ago, the market was all concerned about Italy. The past few days, the market's been very concerned about the Fed and the ECB. Friday morning, the market's concerned about tariffs again. Very similar to the ECB and QE topic. The markets have known for quite some time about the issue of tariffs. The articles shown here are dated March 1st, 2018, March 1st, 2018, March 22nd, 2018, and June 15th, 2018. Therefore, the financial markets are well aware of both issues and have been well aware of both issues for some time. Thus, when we review the charts in this week's video, these two topics will be reflected in every single chart we review. Is it possible that the end of QE in Europe will bring an end to the bull market? Absolutely, positively, yes. Is it possible that a trade war could bring an end to the bull market? Absolutely, positively, yes. But in both instances, if the answer is yes, we know with 100% certainty that the concerns will start to show up in all of the hard data, on all of the charts, on all time frames, and it will show up in asset class behavior as well. So as we scroll through these charts, we can ask ourselves, based on the facts that we have in hand today, how concerned do market participants seem to be about the end of QE in Europe, and how concerned are market participants about the threat of a possible trade war? And to help us answer all of those questions, we will look at 100% facts. No opinions, no bias, no forecasts. So let's get things started by moving to the round of 16. Our World Cup of Markets is a single elimination ETF tournament, similar to the format used in the NCAA tournament in the United States. In the slides that follow, we'll walk through all 16 of these first round matchups. And as we do so, it's important to keep these concepts in mind. I learned an opinion isn't worth that much. It's more important to listen to the market. I became a reactive trader as opposed to an opinionated trader. So what we'll be looking for is there something factual that we can see in the present day that would require some type of defensive reaction, which is quite a bit different than taking action based on an opinion about what might or might not happen. And when we're finished, we'll link back to this concept. The rules of scientific investigation always require us, when we enter the domains of conjecture, to adopt that hypothesis by which the greatest number of known facts and phenomena may be reconciled. The format of our tournament is relatively simple. We'll be using generic and, for illustrative purposes only, simple daily moving averages, the 120 in blue, the 125, the 130, the 135, and the 140. Generic and illustrative purposes only means we're using these generic moving averages to illustrate basic concepts. The market model does not use these moving averages to make timing decisions in any shape, form, or fashion. The charts we'll be reviewing are as of Thursday, June 14th, and at the end, we'll talk about trading activity on Friday, June 15th. Thursday, June 14th was 139 days after the S&P 500 peaked on January 26th of 2018. Therefore, we'll be comparing the present-day charts to the rollover look 139 days after the S&P 500 peaked in October of 2007. This is what a win looks like for defensive-oriented intermediate-term treasuries. This is also what it looks like when the net aggregate opinion rolls over from bullish on the left side of the chart to bearish on the right side of the chart. Here we have a full bore bullish look with blue, the fastest moving average, on top, and the slopes of all of the moving averages are positive, which is almost the polar opposite of the look down here. Blue, the fastest moving average, is on the bottom, and the slopes of all of the moving averages are down. So if we were looking at this chart, we would give the win to intermediate term treasuries. How does the exact same ratio look today, 139 days after the S&P 500 peaked? The answer is it really doesn't look anything, not even remotely close to this look here. And what we're comparing is this look here to this look here. This is a full bore bearish look. This is a full bore bullish look. This look here looks better than the look at any point on this chart here. This is what strong bullish conviction looks like. This looks like a sustainable bullish trend. Even back here, this looks like confusion and indecisiveness. Also extremely noteworthy, 139 days after the S&P 500 peaked, the moving averages are making a new low on this 6-month chart. The chart on the left is 1, 2, 3, 4, 5, 6 months. The chart on the right is 1, 2, 3, 4, 5, 6 months. We're comparing apples to apples. A 6-month period, 139 days after the peak, and 139 days after the peak. New low on the chart. This is making a new high. Pretty easy to see. In the present day, our winner, mid caps. Since the concepts will be basically the same in every single matchup, we'll move a little bit more quickly. 139 days after the peak in early 2008, full bore bearish look with the win clearly going to defensive-oriented gold. In the present day, as of June 14th, 2018, almost the polar opposite. This is a new low, making new highs here, and we have, for the most part, a full bore bullish look with the slopes up and tight here, a win for growth stocks. Small cap growth stocks relative to gold miners, IWO relative to GDX, clearly a win for gold miners over small cap growth 139 days after the market peaked in 07-08. And in the present day, clearly a win for small cap growth over gold miners. New lows being made by the moving averages here, new highs being made by the moving averages here. This isn't a contest that had to go to penalty kicks. This is a blowout. Growth-oriented S&P 500 relative to more defensive-oriented corporate bonds. The rollover look in 2007-2008 is pretty much what we would expect. The net aggregate opinion is bullish here, it's mixed in here, and then it rolls over. Our net aggregate opinion is bearish. When the net aggregate opinion is bearish, the bias is to the downside. Ratio making a new low as far as the moving averages. Different ratio, same conclusions. In this case, a convincing victory by corporate bonds relative to the S&P 500. In this case, we're comparing stocks to stocks. This looks exactly as you would expect prior to the peak in the S&P 500. Many market participants had already migrated to defensive staples. When the S&P 500 peaks, we already have a full-bore bearish look here against discretionary, favoring staples. This is a blowout in favor of defensive staples. 139 days after the S&P 500 peaked, we have a blowout favoring discretionary and growth-oriented consumer stocks relative to consumer staples with that defensive bias. This doesn't look anything like this, and our winner is growth-oriented discretionary stocks. Regional banks relative to more defensive-oriented and quote-unquote safe and stable utilities. Full-bore bearish look 139 days after the S&P 500 peaks in October of 2007, and a new low being made for the moving averages. Almost the polar opposite in the present day. A tight cluster followed by a big move. A tight cluster followed by a big move. Full-bore bearish, new low. Full-bore bullish, new high. Easy to declare the victor here. It's regional banks. NASDAQ 100 triple Qs relative to shorting small caps or RWM in the ETF world. Not a particularly constructive look here relative to the triple Qs. And a much healthier and sustainable look here in favor of QQQ over shorting small caps. The winner, the triple Qs. Growth-oriented retail stocks relative to Treasury inflation-protected securities or TIPS. Full-bore bearish, new low. This is what a downtrend looks like. We move from the upper left-hand corner down to the lower right-hand corner. This is the type of look that we want to avoid. This is what an uptrend looks like. We move from the lower left-hand corner to the upper right-hand corner. This is the type of look that we want to embrace. Winner, retail stocks. Loser, TIPS. Equal weight technology, RYT, relative to shorting the Dow Jones Industrial Average or the Dow 30 via DOG. Full-bore bearish look, new lows, 139 days after the peak. It's the same old story and the same old song and dance. New highs, full-bore bullish look, favoring the growth-oriented equal weight technology ETF relative to the bearish-oriented shorting the Dow 30 or DOG. Winner, equal weight tech. Eliminated, shorting the Dow. Total stock market VTI relative to a diversified basket of bonds or AGG. 139 days after the peak, the trend and chart clearly favors owning defensive-oriented bonds over the stock market, and that was very, very helpful because the stock market falls a long, long way from this point here until we reach the low in March of 2009. This look here is in stark contrast to the full-bore bullish look and new highs that are being made. This chart, for the most part, is moving from the upper left to the lower right. This one is moving from the lower left to the upper right. We want to avoid this look. We want to embrace this look from a probability perspective. Your clear winner in runaway fashion, total stock market, eliminated aggregate bond ETF. As we go through this, these aren't just charts. These are psychological profiles. They're telling you what market participants are thinking about future economic outcomes, future market outcomes, and every single outcome and topic you can think of on every single possible time frame. Prior to the S&P 500 peaking, prior to, this ratio is already looking vulnerable in here. A flattish, indecisive look, a tight cluster and a rollover. After we could see this, measure it, and put it in a model, really bad things happened all the way into early March of 2009. Full bore bullish, new highs. Full bore bearish, new lows. 6 month period, 139 calendar days after the peak, 139 calendar days after the peak. No opinions, no forecasts, 100% facts. Let's say you don't like risk-on, risk-off ratios, so let's just look at the S&P 500 facing off relative to the S&P 500 in the present day. So this is where we are in our bracket. S&P 500 2007, 2008 versus the S&P 500 2017, 2018. Look how vulnerable this chart looks here in mid-November 2007. And this is the period that we want to compare to the present day. Easy to declare the victor here. The victor would be the S&P 500 2017, 2018, eliminated from the round of 16. Economically sensitive transportation stocks relative to 1 to 3 year treasuries. Full bore bearish and a new low 139 days after the peak. This really doesn't look anything like this. We're moving from the upper left-hand corner to the lower right-hand corner. This is what a downtrend looks like. We're moving from the lower left-hand corner to the upper right-hand corner. This is what an uptrend looks like. Defensive treasuries eliminated. Moving on to the next round, transportation stocks. The result 139 days after the peak in 2007 was the exact opposite. Transports would have been eliminated and defensive treasuries would have moved on to the next round. Technology stocks in isolation, 2007-08 versus technology stocks in isolation, 2017-2018. The winning chart is clearly on the right side of our screen. This is the look we want to embrace. This is the type of look that's extremely concerning. How about if we look at the average stock, full bore bearish, new low value line geometric index? How does the exact same index look 139 days after the peak in calendar year 2018? This chart is moving from the upper left to the lower right. This one is moving from the lower left to the upper right. Blue, the fastest moving average, is on top here. The slopes are all up. Blue, the fastest moving average, is on the bottom. The slopes are all down. After we could see this, measure it, and put it in a model, really bad things continued to happen. The winner, the right side of your screen, or the present day, it moves on, eliminated. In the present day, if we felt that the ECB announcing the end of QE was going to send all risk assets into a tailspin around the globe, logically, we would expect shorting the S&P 500, a risk asset, to be more attractive than going long Eurozone stocks. And that's exactly what happened as the market rolled over. Net aggregate opinion is bullish in favor of owning the Eurozone over shorting the S&P 500. The net aggregate opinion is mixed or indecisive in here, and then it rolls over against being long the Eurozone and favors shorting the S&P 500. And remember, the concept of the ECB ending QE, that is not a new concept to the financial markets. Market participants have had 286 days or 9.5 months since this article appeared on Thursday, October 26, 2017, to crunch every possible number related to the end of QE and look at every possible scenario. Therefore, logic would tell us in the present day, after crunching all of those numbers and looking at every possible scenario, if there was concern in the market, we should be able to see some of it in the present day version of this chart, just as we could see it here and just as we could see it here. We moved to a full bore bearish look before the calendar flips over to 2008. This is the same ratio, June 14th, 2018. And remember, we're crunching numbers about the end of the ECB way back here. I can assure you that large money managers and the largest hedge funds have looked at this from every possible angle. If they had decided that the end of QE was going to bring down the bull, all of the charts that we just looked at would look quite a bit different. They would look a lot more like this or this, and we really wouldn't expect them to look like this. Is it possible that the end of QE and/or a trade war brings down the bull market? Absolutely, positively, yes. But that's an opinion or conjecture at this point relative to the charts. We make decisions based on the facts in hand. If this chart morphs into something like this, which is well within the realm of possibility, then we're happy to make the necessary adjustments. As of June 14th, 2018, the look of this chart speaks for itself, and the look of this chart spoke for itself in late December 2007 and in early November 2007. We'll continue to take it day by day with that flexible, unbiased, and open mind. So let's summarize the results of our World Cup of Markets and fill out our ETF bracket. Advancing on to the next round, mid-cap, growth stocks, small caps, the S&P 500, discretionary stocks, regional banks, the NASDAQ 100, retail stocks, equal weight technology, the total stock market, small caps. The S&P 500's present day chart beat out the chart in 2007, and it wasn't even close. Transports, technology in 2018 stomped the chart from 2007. The value line geometric index in the present day clearly outpaced the look of the chart in 2007, 2008. And the present day chart of being long Eurozone stocks is clearly the winner relative to shorting the S&P 500. We can learn a tremendous amount from the ETFs that advanced out of the round of 16, and we can learn a tremendous amount from the list of losers from the round of 16. Intermediate treasuries, gold, gold miners, corporate bonds, consumer staples, utilities, shorting small caps, tips, shorting the Dow, a diversified basket of bonds, long-term treasuries, the S&P 500's 2007-2008 chart, 1 to 3 year treasuries, the technology chart 2007-2008, value line 2007-2008, shorting the S&P 500. Let's think about the results of our tournament in the context of these quotes. I learned that an opinion isn't worth that much. It's more important to listen to the market. The rules of scientific investigation always require us, when we enter the domains of conjecture, the rules of scientific investigation always require us to adopt that hypothesis by which the greatest number of known facts and phenomena may be reconciled. Is it easier to reconcile this list of head-to-head winners with the hypothesis that stocks could continue to surprise on the upside for many years to come? Or is it easier to reconcile this list of head-to-head winners with the hypothesis that the stock market is in the process of making a major top. And since the charts that we reviewed were as of the close on Thursday, a fair question might be, don't you have to redo the whole analysis because the S&P 500 was down intraday on Friday? In this analysis, we used the simple 120-day moving average, the 125, the 130, the 135, and the 140. How much of an impact can one trading day have on the results? Said another way, how much does one day impact the 120-day moving average? If you know how simple moving averages are calculated, you know the answer. One day really doesn't change anything. On average, 99.23% of the data points that were used to construct this analysis would remain unchanged. Therefore, if we updated all of these charts as of the close on Friday, June 15th, they would basically look identical. And it's important to note, every single statement that we've made in this video is based on the facts that we have in hand today. And the facts that we have in hand today, just as the facts that we would have had in hand looking at this chart on February 25th, 2008, this chart can't predict the future, and this chart can't predict the future. But both charts, and every single chart that we've reviewed in this week's video, can unequivocally help us assess the probability of good things happening relative to the probability of bad things happening. Regardless of how strong the charts look in the present day, the probability of bad things happening is never zero. And even if these charts are correct from a probability perspective and the S&P 500 eventually goes on to make a new all-time high and follows the NASDAQ, we absolutely, positively might experience additional volatility before that happens and additional backfilling before that happens. As we head into next week, we will remain open to all outcomes. And the only way that we can properly react to deteriorating charts and deteriorating asset class behavior and deteriorating data is to keep that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.